Semiconductor stocks are falling hard. Nvidia fell about 6%. AMD lost almost 11%. Micron dropped 13%. And Broadcom, a nearly 20% decline in just 2 days. In a single session, roughly $1.3 trillion disappeared from U.S.-traded semiconductor stocks. That is not a normal quiet pullback. So here's the question. Is this finally a buying opportunity? Or is the market warning us that the AI chip trade has gone too far? That question matters because the semiconductor story still sounds incredibly strong. AI needs chips. Cloud companies need more data centers. Advanced memory is in demand. And the world is becoming more digital. All of that is real. But a real trend can still become overvalued. A great company can still be a bad investment at the wrong price. And the risk is not that semiconductors suddenly become useless. The risk is that expectations became too high. So today, we're going to ask a simple question. When chip stocks fall sharply, how do you tell the difference between opportunity and warning? This video is for education only. It is not financial advice. Let's break it down in simple English. Before we start, I want your opinion. When chip stocks fall this hard, what do you see? A buying opportunity or a warning sign? Comment, opportunity or warning. And next week, I'll use today's 5-question framework to analyze the semiconductor stock you request the most. Then we'll see whether your call was right. First, what actually happened? The simple answer is that investors became less willing to pay any price for the AI story. Semiconductor stocks had already experienced a huge rally. AI demand pushed chip companies higher. Memory stocks moved higher. Equipment stocks moved higher. Data center suppliers moved higher. And little by little, investors started assuming that the AI infrastructure boom would continue almost perfectly. Then the market became more sensitive. A disappointing outlook from Broadcom helped trigger one major sell-off. The company was still talking about AI growth, but the numbers were not strong enough to match what some investors had already priced in. And that is an important difference. The market was not asking, is AI growing? It was asking, is AI growing fast enough? Then concerns about AI spending came back. The market started questioning the enormous amount of money flowing into data centers. Billions are going into chips, servers, networking, power, cooling, and new data center capacity. Investors are no longer asking only, how much are companies spending? They're starting to ask, what return will that spending generate, and how quickly? Later in June, the Philadelphia Semiconductor Index dropped another 7.9%. Nvidia fell more than 4%. AMD and several other semiconductor companies suffered sharp declines. Micron and SanDisk both fell around 13%. The fear was not that AI suddenly disappeared. The fear was much simpler. What if the industry is spending too much, too fast? But here's where the story gets interesting. Only 1 day later, stronger forecasts from Micron and Qualcomm helped add more than $400 billion back to semiconductor stocks. Micron benefited from strong AI-related memory demand. Semiconductor equipment names also moved higher. So what does that tell us? The market is conflicted. Investors still believe in AI demand, but they are no longer willing to ignore valuation, spending, and earnings risk. That is the real story. To understand chip stocks, you need to understand one very important idea. Semiconductors are cyclical. That simply means the industry often moves through repeating periods of boom and slowdown. Here is the basic cycle. First, demand rises. Maybe smartphones are selling well, or cloud companies suddenly need more servers, or AI creates a whole new wave of chip demand. Suddenly, customers want more chips than manufacturers can supply. A shortage begins, prices rise, margins improve, chip companies report strong earnings, and investors become excited. Then companies expand, new factories are built, more manufacturing equipment is ordered, production increases. But this is where things can get misleading. Imagine a customer actually needs 100 chips to build its servers, but supply is tight, Delivery times are getting longer, and nobody wants to be the company that runs out of chips. So the customer orders 130. Maybe it places orders earlier than usual. Maybe it builds extra inventory just in case. Other customers do the same thing. Suddenly, the order books look incredible. To Wall Street, demand looks almost unstoppable. But here is the problem. Some of that demand may not be final demand. It may simply be customers protecting themselves from a shortage. And once supply improves, those same customers look at their warehouses and say, "Wait, we already have enough." That is when orders can slow much faster than investors expect. The shortage created extra ordering. The extra ordering created inventory. And the inventory eventually creates a correction. Now let's add AI to the story. AI changed the semiconductor cycle, or at least investors believe it did. Demand for advanced AI accelerators created enormous growth for companies like Nvidia. AMD became a major alternative in AI computing. Broadcom benefited from custom AI chips and networking. TSMC became even more important because it manufactures many of the world's most advanced chips. ASML provides the advanced lithography machines needed to produce leading-edge semiconductors. Memory companies benefit because AI systems require high-performance memory. And semiconductor equipment companies benefit when manufacturers expand capacity. This is why the AI semiconductor trade became so broad. It was never just Nvidia. It became an entire value chain. But the stronger the story became, the higher expectations moved. And that is the key risk. When a stock is cheap, investors may accept normal growth. When a stock is expensive, normal growth may not be enough. The company may need exceptional growth, then another exceptional quarter, and then another one. This creates a strange situation. A company can report good results, and the stock can still fall. Why? Because the market expected better. This is what many beginners misunderstand. Stocks do not only react to whether the news is good or bad, they react to the difference between reality and expectations. That is why semiconductor stocks can fall even when AI demand is still growing. The market may not be saying AI is dead. It may simply be saying we already paid for too much future growth. This brings us to one of the most important ideas in investing. A great company is not always a great investment at every price. Let me say that again. A great company can still be a bad investment at the wrong price. Imagine a company with excellent technology, strong management, growing revenue, high margins, and a dominant market position. That sounds perfect. But now imagine investors become so excited that they price the stock for years of nearly perfect execution. Here is a simple example. Imagine the market expects a chip company to grow earnings by 40%. The company reports 25% growth. 25% is still strong. For most businesses, that would be an excellent result. But if investors already paid for 40% growth, 25% can feel like a disappointment. The business is still growing. The stock may still fall. That is the difference between a great company and a price built on great expectations. This distinction is extremely important in semiconductors. Nvidia can remain an AI leader. TSMC can remain a critical manufacturer. ASML can continue owning unique technology. Broadcom can continue expanding its AI business. AMD can continue competing. Memory demand can remain strong. And semiconductor stocks can still go through painful corrections. Business quality and entry price are two different questions. A beginner often asks, "Is this a good company?" A more experienced investor asks, "What does the current price already assume?" That is the better question. So what are the main risks right now? Let's keep it simple. Risk number 1, AI capital spending. Big technology companies are spending enormous amounts of money on AI infrastructure. That supports demand for GPUs, networking chips, memory, advanced manufacturing, and semiconductor equipment. But what happens if those companies slow down? Chip demand expectations can change very quickly. A hyperscaler does not need to cancel AI. It may simply say, "We are still spending more, but growth in spending will slow next year." For a semiconductor, stock priced for extremely high growth, that can matter. The risk isn't zero AI spending. It's slower than expected spending. Risk number 2, the geopolitical tech war. Let's be honest. Semiconductors are no longer just another technology industry. They have become strategic assets. Look at what is happening around ASML. Look at export restrictions on advanced chip technology. Look at China's controls on critical materials. And look at the continuing risk around the Taiwan Strait. For global semiconductor companies, government policy can change the economics of a business very quickly. A new export rule can reduce the products a company is allowed to sell. It can limit access to major customers. It can change expected revenue. And it can force an entire supply chain to adjust. That is why geopolitical risk matters so much in semiconductors. The technology may still be excellent. The demand may still exist. But a political decision in Washington, Beijing, or another major capital can suddenly change who is allowed to sell what and to whom. Risk number 3, competition. AI chips are extremely valuable. That attracts competition. AMD wants more AI accelerator share. Cloud companies are designing their own custom chips. Broadcom works with major customers on specialized AI hardware. New architectures are being developed. Competition does not mean Nvidia disappears, but more competition can affect pricing power. And pricing power matters. Risk number 4, margin pressure. High margins attract attention. Customers look for cheaper alternatives, competitors invest, suppliers negotiate. And as products mature, pricing can become more competitive. A company can still grow revenue while profit margins weaken. That matters because stock valuations often depend on future profits, not just sales. Risk number 5, inventory. This is the classic semiconductor risk. If customers order too much during a shortage, inventory can build. When the correction begins, orders may slow much faster than expected. And because semiconductor manufacturing and infrastructure involve large fixed costs, a demand slowdown can hurt earnings quickly. But a falling stock price is not automatically a warning sign. Sometimes a pullback is healthy. Imagine a semiconductor stock rises 100%. Investors become excited. The valuation expands. Then, traders take profits. The stock falls, but the company continues growing. Demand remains strong. Margins stay stable. Inventory remains controlled. And management does not reduce its outlook. In that situation, the stock price may simply be cooling down. The market is removing excess excitement. That can be healthy. A strong industry does not need its stocks to rise every day. In fact, constant vertical price increases can create more risk. Corrections can reset expectations. They can reduce speculative trading. And they can force investors to focus on earnings again. They can also create a clearer separation between strong companies and weak stories. Look at the recent semiconductor volatility. After one sharp sell-off, stronger forecasts from Micron and Qualcomm quickly changed market sentiment. Hundreds of billions of dollars in semiconductor market value returned. That showed how quickly the market can react when earnings support the AI demand story. So a pullback can be healthy when the price changes, but the business does not. But sometimes a pullback is a warning. The key is to watch whether the business story is changing. Are customers reducing orders? Is inventory building? Are companies lowering earnings forecasts? Are margins weakening faster than expected? Are large technology companies slowing AI spending? Are export restrictions becoming more severe? Is competition pushing prices lower? One bad trading day is noise, but several negative signals together can become a pattern. This is especially dangerous when valuations are high, because expensive stocks have less room for disappointment. Think about it this way. A stock priced for average results can survive average results. A stock priced for perfection cannot. That is why semiconductor corrections deserve attention. The question is not, did the stock fall 10%? The question is, why did it fall? Did investors simply become nervous? Or did the earnings story actually weaken? Those are two very different situations. So how should a beginner think about a semiconductor sell-off? Here's the MarketMind AI 5-question framework. Question 1. Is demand still growing? Look at data centers, AI spending, memory demand, cloud demand, and customer orders. Question 2. Are earnings expectations too high? A company may still grow, but is the market expecting perfect growth? Question 3. Is inventory building? In semiconductors, rising inventory can be an early warning that supply is catching up with demand. Question 4. Are margins holding up? Revenue growth looks good, but are companies still keeping strong profits? Question 5. Is the stock still priced for perfection? This may be the most important question. Ask yourself, what has to go right for the current valuation to make sense? AI spending, customer demand, pricing power, margins, no export problems, no major competition. If everything has to go perfectly, the risk may be higher than it looks. So, are semiconductor stocks a buying opportunity or a warning sign? The honest answer is, it depends on why they are falling. If demand remains strong, earnings keep growing, inventory stays controlled, and the sell-off is mainly a valuation reset, then the market may simply be cooling down. But if AI spending slows, orders weaken, inventory rises, margins fall, or expectations remain too high, then the correction may be telling us something more important. The risk is not that semiconductors are useless. The risk is that investors paid for a future that became too perfect. A real trend can still become overvalued. A great company can still be a bad investment at the wrong price. And a falling stock is not automatically cheap. Next week, I'll use this 5-question framework to break down one semiconductor stock. Which one should it be? Nvidia, AMD, Broadcom, TSMC, ASML, or Micron? Comment the ticker below. I'll take the stock with the most requests and go deeper. Demand, margins, inventory, valuation, and AI spending exposure. Then we'll answer the same question. Is the sell-off creating an opportunity or giving investors a warning? And we'll see whether your call from the beginning of this video was right. This video is for education only. It is not financial advice. We decode the markets. You make smarter decisions. I'm MarketMind AI. See you next time.